So one thing that's interesting is research has shown that the average stock actually doesn't perform very well. Most of the stock market's returns come from a pretty small number of names.
Yeah.
And it tends to be certain industries where you're able to get excess profits. So tech, healthcare, energy, communications, those tend to be the sectors that have a higher than normal, like higher than average rate of outperformers. So I focus on certain sectors more so than others. But primarily what I do is I look for profitable companies that have economic moats, meaning that they're hard to disrupt. They have a lot of kind of inbuilt advantages that are hard for competitors to overcome, which allows them to have pretty high margins.
Welcome to Paychex Thrive, a business podcast where you'll hear timely insights to help you navigate marketplace dynamics and propel your business forward. Here's your host, Gene Marks.
Hey everybody, it's Gene Marks and welcome back to another episode of the Paychex Thrive podcast. I'm thrilled to have back with me Lyn Alden. She's the founder of Lyn Alden Investment Strategy, and she is the author of Broken Money: Why Our Financial System is Failing Us and How We Can Make It Better. First of all, Lyn, your book's doing pretty well, isn't it?
Yes. Yeah, people are enjoying it. It was a pleasure to write it, and definitely one of the more meaningful things I've kind of worked on recently.
Yeah, I believe it. And you have got such a great and engaged following, mostly on Twitter. I mean, I'm not sure if you're as active elsewhere, but people taking copies of your books and, taking photos of it all around the world and in different places and whatever is, it's got to be really heartening. Are you working on anything new?
Not in terms of a book. I'm focusing on the rest of my business. I do have ideas for a second book, but it's not something I'm rushing into because it is a very big task to put together a book.
It really is. And I know that it's gratifying to write the book, and I know that you enjoyed the process, although it's a lot of hard work. I'm just kind of curious, for all of us that are out there. I mean, like, do you think it's worth it writing a book? Like, was it? It certainly gives you exposure and helps your brand. I get that. But financially, would you recommend the exercise to others?
I think it depends. I mean, for example, I went into it knowing that as far as my business lines go, it's not a great ROI. Compared to that amount of time spent elsewhere in my business. So for me, it was not mostly a financial decision. It was mostly that it was distracting not to write the book. Like I had a book that formed in my head, and so all the other benefits of writing the book were what I was focusing on. Of course, it did well financially, but as compared to other business lines, it's generally you rarely write a book for money. You write it for those other aspects.
Yeah, I'm glad you said there was actually a really good article written by this woman who really dug through this lawsuit that was going on between two large publishing houses recently, where a lot of the details of the publishing industry came out. And I'll send you a link to it and we can share it in the show notes as well. But the conclusion was that nobody makes any money writing books. Not that it doesn't, have an impact. But it's the big name, people, the celebrities, those kind of people, they make the money. So for most of us, like I've written 6 books and, they suck. I mean, like I haven't really made that much money off of doing it. I mean, they've more than broken even, but, it's more like a branding thing. And it's also just an opportunity to have it's like a mental exercise. You know what I mean?
Yeah. And there are like different, different pieces of content have different, they reach different people. They have different purposes. So for example, instead of pointing people to 10 different articles, I can point them to a book that really kind of walks them through a more complete picture of kind of what I'm trying to share, and is purposely written in such a way to be as evergreen as possible so that 5 years from now, it's still referable.
That is the biggest challenge that you have when you're writing a book on the topics that you focus on, is keeping it evergreen because the topic could get stale. So, okay. So you wrote the book. It's great. I bought it. I read it. I recommend it to all of you guys watching it. It's just a sound, basically. It basically walks you through the history of money. And it's, you like you call it, through the lens of technology and how monetary systems have changed and things that we should be aware of and how economies work. It's a really great, insightful book. Besides the book, for all of you guys watching and listening, Lyn writes an amazing monthly newsletter that she shares. It's free. I haven't paid you for this, Lyn, so sorry. I don't think there's a subscription. But you do have a paid subscription base, correct?
Yeah, I have a premium service that comes out every 2 weeks, whereas the public newsletter comes out roughly every 6 weeks. So
Got
about
it.
about 8 times a year.
Got it. Okay, that sounds good. So, and I really should subscribe because I am a fan. This last newsletter that you wrote was your April newsletter, and it was all about investing. And I thought, Linda, let's talk about that today. We have a lot of watchers and listeners. Our audience are business owners. The average age of the U.S. small business owner is 55 years old. More than half of the business owners in this country are over the age of 50. When I go out and I meet clients and I speak to groups and associations like all around the country, it's just a bunch of like older people that are in the room, and they have, a very strong interest in investing wisely, as we do all, but they have a little bit more capital at risk. And your April newsletter really, really dug into certain strategies of investing. And I wanted to, I wanted to touch on some of the main points. So, for starters, Lynn, you talk about a 60-40 portfolio. And you also say that you feel that the expected return, the rate of return on this portfolio will be lower than what we've seen over the next 40 years. So can I ask you, first of all, to explain to us what you mean by a 60-40 portfolio, whether you recommend it or not, and why you believe that this rate of return is likely to be lower?
Sure. So the 60-40 portfolio refers to the classic 60% stocks, 40% bonds portfolio that is often used as like a baseline. And the reason that portfolio is constructed is because, generally speaking, stocks more often than not are inversely correlated to bonds. So stocks do better overall, but then during recessionary environments, when stocks generally do poorly, bonds usually do pretty well. Interest rates fall, bond prices rise. And so if you have that 60-40 portfolio and balance it, you can get most the returns associated with equities, but with less volatility. And so that's kind of how that portfolio is constructed.
Okay.
But the challenge is that that portfolio became popular over the past 40 years, which was an era of steadily falling interest rates from a very high level. And so, especially in the first 3 decades of that, bonds did very well because you both had high interest rates, so you're getting paid well to own them. But then also the interest rates are steadily falling, which means your bond price is appreciating as well. And so that was a very good strategy. The problem is that once you get down to pretty low interest rates, especially relative to the ongoing money supply growth that's happening, those bonds become less attractive as part of a portfolio. And generally speaking, when you look at inflationary decades, bonds historically lose a lot of their inverse correlation to equities. They start to, if anything, become more positively correlated with equities, which makes them less compelling as at least as a 40% portfolio chunk. And generally speaking, when you have an inflationary decade, and in modern history, we've had really four of them. There's the 1910s, the 1940s, the 1970s, and then to some extent the 2000s, although that one had a lot of offsets. But what you generally have in common of those four inflationary decades is that a stock bond portfolio does not do particularly good, especially in real terms. Let alone, nominally it could do decent, but it's still usually not great. And so the newsletter explored what does do well in those decades. And generally the answer is commodity type assets, commodity producers, could be hard monies like, gold. Obviously Bitcoin doesn't have that track record, but now Bitcoin can be in that category as well. You have a number of those types of things that generally do pretty well in those inflationary environments. If anything, some of those are causing the inflation that's happening. You kind of have these like energy and commodity kind of capex cycles where you underinvest for a while, and then you get higher prices, so you have to invest more, and that eventually results in oversupply, so you get a
Right.
period of lower prices. But generally speaking, that tends to be a more useful diversifier in, say, an equity portfolio, if you want to have a portfolio that's geared not entirely to disinflation, and instead want to have a portfolio that is kind of prepared for either disinflationary scenarios or more inflationary scenarios.
You've said though, but I mean, you say that, listen, this is, this traditional 60-40 split is, you don't think the rate of return on this is, you think it's going to be lower for the next 40 years though? I mean, you just said that like there were certain decades where we were in an inflationary environment, but these didn't go on for 40 years. Why do you seem so sort of, pessimistic on this type of split now.
Well, so yeah, when I make that comparison, I'm basically saying that the next 40 years are less unlikely to be as good as the prior 40 years. And so, of course, some years and some decades will be better than others. But the main reason is that the past 40 years, that steadily falling interest rate was a huge tailwind, both to bonds and then also to equities.
Right.
Because if you're investing in equities, if you can get 15% on a treasury, you're not going to pay very much for an equity.
Sure.
But as they steadily fall to 10%, 5%, and almost zero at one point, you can pay very high valuations for an equity because you have a lower opportunity cost. And so the problem is that when we enter an environment of, say, flat interest rates or even rising interest rates more structurally, then you have an issue where equities, they're still generating earnings, they're still growing in that sense, that they still have like these nominal long-term earnings growth,
Sure.
but that additional valuation increase, say, the average, kind of CAPE ratio of the market, so cyclically adjusted price to earnings ratio, when that goes from 15 to 30 on top of growing earnings, that's a really strong equity return environment. And if you go through a period where valuations are just flat now, let alone
Right.
potentially falling on top of long-term higher earnings, generally you just get lower returns. They still could be decent, but they're not likely to be as good as we've come to expect.
Got it. Obviously, individual stocks and individual bonds, you can play out their own ways. So you're talking in general terms. So when you talk about having a 60-40 portfolio in stocks and then bonds, what's your recommended makeup of that portfolio? When you say 60% should be in stocks, are you saying they should be in a Dow fund or in a S&P 500 fund or something similar to that?
So I think that the S&P 500 is kind of a classic benchmark.
Mm-hmm.
It does have kind of selection bias that the U.S. was the best performing market over the past 40 years, and so most stock markets globally don't perform that well. The U.S. one's done very well. And so there's a couple of things you can do to potentially improve it. So evidence has shown over the long term that an equal weight S&P 500 historically outperforms the normal S&P 500. And what I mean by that is the normal S&P 500 is weighted by market capitalization. So, for example, Apple as a multi-trillion-dollar company has a much bigger weighting than, say, American Express, which is a large company, but it's nowhere near the size of Apple. So it's way more allocated to Apple than American Express. Whereas an equal weight S&P 500 would put equal amounts into each of the 500 companies and rebalance that on, say, a quarterly basis. And that has periods of time where it outperforms and periods of time where it underperforms. But in aggregate, it has generally outperformed. And that's because you're generally a little bit less concentrated in the biggest stocks while still being invested in the same top 500 companies. You can also take your equity section and diversify a little bit internationally, where you have some foreign developed, some foreign emerging. And it's one of those things like, for one decade, that'll feel like a drag in a portfolio. For example, if you had any international exposure over the past decade, it's pretty much only been for the worse because U.S. markets have gone almost straight up and a lot of other markets have gone sideways. But there's other decades where American equities do pretty poorly. They chop along, they go sideways, they don't do very good. Whereas other markets experience better returns. And generally speaking, when they have that starting point of being cheaper and under allocated to because they've had a long period of bad returns, that's generally when they're in a better position to offer better returns going forward. So I would at least consider some geographic diversification within that equity slice.
In your newsletter, I mean, you do share some of the stocks that you own and some of the places that you invest in. Do you personally, Leland, do you invest in stock market index funds, Vanguard funds or Fidelity or whatnot, or are you more of a targeted owning specific shares or specific bonds?
So because I've been investing for like 2 decades, I tend to like that approach of kind of knowing what I own.
Yeah.
But I still also do use some index funds as well. One of my retirement accounts is index funds. I also use index ETFs for some of my foreign exposure because I'm less able to pick out a lot of good companies internationally. There's still some internationally that I do, but just the number of individual names I'm going to like fully understand in an international context is lower. So I often just kind of, spread the diversification out by owning some ETFs. So for me, it's a mix of both.
Sure. As a private investor, I mean, this is what you're spending full time on. I mean, you're on this a lot. I'm curious if you do have any advice for our audience when it comes time, if they are interested in holding individual shares. What are the kinds of things that you look at in a company to help you decide whether or not it's a good investment or not?
So one thing that's interesting is research has shown that the average stock actually doesn't perform very well. Most of the stock market's returns come from a pretty small number of names.
Yeah.
And it tends to be certain industries where you're able to get excess profits. So tech, healthcare, energy, communications, those tend to be the sectors that have a higher than normal, like higher than average rate of outperformers. So I focus on certain sectors more so than others. But primarily what I do is I look for profitable companies that have economic moats, meaning that they're hard to disrupt. They have a lot of kind of inbuilt advantages that are hard for competitors to overcome, which allows them to have pretty high margins. And then I look for reasonable valuations. So, for example, I often look for a dividend adjusted price to earnings to growth ratio that's below 2. So, for example, if a stock is growing earnings at 10% a year, I generally want to try to buy that for under 20 times earnings, if possible. I don't want to pay 40 times earnings for a stock with that type of growth. And so, basic certain valuation checks, and then they also kind of inform me. Like if I look at a market, I see a lot of stocks that are overvalued. It might make me kind of dial my exposure down a little bit to that market. And if I see another market where there's a bunch of stocks that all seem to be trading at pretty reasonable valuations, I might increase my exposure to that market. So in addition to helping with individual stock selection, it helps with understanding the expected forward returns of say an index. So for me, it's good balance sheet, profitable company, and then reasonable valuation.
I have an uncle. He's since passed away. He was in his 80s at the time, but he was a lifelong investor, and he's on my wife's side of the family, and lived in London. And he was the old school investor. He would read the Financial Times every day. He would get the shareholder reports. He would always go to the shareholder meetings. He would buy and hold for a long period of time. He would evaluate management of the company, and whether or not he trusts them or thinks they know what they're doing and how they answer questions and how transparent they are, all those kinds of factors. Are those factors even relevant today? I mean, you didn't mention that right now. And I just wonder if there's a reason why you didn't mention that, those kinds of things.
Yeah, so that comes down to sector by sector, especially if it's a smaller company, more and more diligence is needed. And so for me, those types of things can build high conviction in a more concentrated position. For my approach, what I do is I blend macro with individual company analysis, because the macro can inform me of what types of exposures I might want to have, and also looking at individual companies helps inform my macro view. And so because I view this as a period of time where macro is very important, right? So for example, with the kind of the very large fiscal deficits, for example, and some of the geopolitical dynamics and things like that, those forces, there are decades where they don't really matter that much, and there are other decades where they matter quite a bit. And so I generally view those top-down forces to be quite substantial at this time. And so for me, for most companies, I don't do that super deep due diligence in the same way that I would if I was, say, running a really concentrated book, and only have 10 or 15 stocks. That's when you really have to kind of dig down into it. But there are certain stocks, certain sectors that I do that type of analysis on.
It obviously depends on a lot of different factors, but I'm wondering if you have selling a stock, I think to me is harder than buying it. And different people have different parameters, lines that they reach when it comes time to trigger a sale. Do you have something like that? Is there something out of the box you're like, well, when we get to a certain valuation of a certain, times earnings or a certain stock price, I'm definitely going to sell? Or are there other factors that go into your decision when you decide to unload a stock?
Yeah, there's really two main reasons to sell it, the way I approach it. One is that the valuation became unattractive. So if I owned a stock and thought it was worth 20 times earnings, and I bought it at 15 times earnings, but now it's worth 30 times earnings, and the growth has not doubled, right? The growth rate's not doubled, but the market's just paying twice as much for it. Um, that's a candidate for me to either trim the position or potentially remove it entirely. And it's usually, I mean, it usually feels pretty good because it generally means that your investment performed very well. The other reason would basically be that the thesis has changed. Let's say I had certain growth expectations for the company. I had certain reasons to expect why they would gain market share while maybe their overall industry is growing. And if there starts to be evidence that that's not the case, and it's not just a bad quarter or a cyclical hiccup, it's actually like there's more structural signs that the thesis was maybe inaccurate, then I might have to sell even if the it's in the red. And that's probably the hardest type of sale because people they benchmark to their starting price. They have like a sunk cost fallacy. Whereas what you really have to do is analyze your portfolio kind of fresh and think like if I were investing today, would I pick this today? Because if I'm not going to pick it today, then why do I still hold it? Um, and so
That's actually great advice.
yeah, so that's the hardest reason to have to sell a company. Luckily, it doesn't happen too often, but it does happen from time to time.
And about how many individual stocks do you personally own right now?
I own a few dozen.
Okay.
I own probably 4 dozen actually. I own quite a big number, but that's often because their ETFs, for example, they might be in a sector where they're not giving me the type of exposure I want, and I'm able to kind of go that more kind of blend of enough names that I have a pretty diversified base, but that I'm able to
Mm-hmm.
sculpt it a little bit more than I could if I was just relying on pure indices. And those names tend to be spread. I try to diversify across sectors, but there's inherently certain sectors that I'm more interested in or more knowledgeable on than other sectors. And
Right.
so, yeah, there tends to be a decent amount of sector concentration.
That gets me back to, I'm glad you brought that up. I mean, you say there are certain sectors that you're more knowledgeable about. I mean, back at this before your time, but during my time, Lynn, a very famous money fund manager named Peter Lynch, he was the manager of the Magellan Fund at Fidelity,
Yeah.
wrote a couple of big best-selling books. His whole strategy was you buy what you know. You walk around the shopping malls of the day and you see where your kids are, what stores they're flocking to, and you don't invest in areas that you're just you don't understand what the company does, or you're not familiar with the industry. I mean, you just said that you tend to lean more towards some investments that in sectors that you're more familiar with. So do you buy into that strategy? Like I bought stock. I bought like American Airlines stock and Marriott stock because I use them so much, so I have a real touch and feel as to how the businesses are run. Do you think that's a good strategy? Is that something that you do?
I think it's a good starting point. It's challenging because some companies are inherently business to business, so it's less likely that you would encounter them. So if you only use that strategy, it kind of pigeonholes you into B2C type of businesses, business to consumer businesses. So I wouldn't only rely on that approach, but I do think that that's a good starting point. Basically, if you use a product on a regular basis, you know what makes it good. You know what you'd like the company to make in the future, related products. And so that could be a good insight. That's a type of research that's basically already done for you because you've already done the product research, just by having used it. But yeah, there's like all sorts of kind of business to business type of investments as well, where I might have, I'm not in a position where I'm going to use their products, but I have to understand those products. And then in addition, if you know a company very well, you could get blinded by valuations or something. Like you might, for example, just not look at the valuations because you like the company, whereas you do have to be diligent around, is the company kind of affordably priced relative to its fundamentals and growth expectations.
I was a controller at a publicly held company years ago, so 30 years ago. And we were a small biotech company at the time. And we had a product in clinical trials. And the valuation of the company was obviously aligned with how those clinical trials were going to go. And like, I'll never forget this, Lynn. So like the results of the clinical trials came back and they were negative, right? So we were like, okay, this is going to, have a big impact on our stock. And I remember it was me and the CFO and the CEO of the company. There was only like 100 people in the company. We drew up the list of our institutional investors in our company. And when the markets were opening next morning at 9:30 or whenever they opened, we called them within the legal time frame. It was like 10 minutes before the market opened. We each called our institutional investors, personally to tell them the results of this trial. So frankly, so they can get out. So they're happy to get out while they can. And hopefully we'll come back in the future when we have, we're working on other stuff. Like they're not getting, messed around. And that's exactly what they did. So, within 5-10 minutes after the market opening, our biggest investor pulled out and the stock lost literally 50%, of its price. And by the time you woke up in the morning and checked your stock price of our price, you were already like left out, in the cold,
Yeah.
So, there is this perception, and my story is meant to tell you that it's more than a perception, that not that the market is rigged, but there are big players that go back and forth to each other. What are your thoughts on that and the impact on individual investors like you? I mean, how does that scare you, concern you, or is that just one of the risks that you just assume?
So generally speaking, the smaller, more concentrated the company, the bigger of a risk of something like that is. That's actually a reason that I don't personally invest in small biotech, because I don't have an edge. Like I'm not knowledgeable in that subject matter. There are people that that's their whole profession. They run like a biotech fund, for example. They look over these trials all the time, whereas that's outside of my area of expertise, right? And so for me, I like the mid cap space or sometimes large caps, where they're less prone to those really big kind of one-time news events that can affect them that significantly. But yeah, basically the market is somewhat rigged against the little guy. That's kind of been the case. And there's even for example, in recent years it's become popular that if you track politician portfolios, they're actually outperforming some of the best hedge fund managers. And
wow, what a surprise!
Yeah, they have a lot of information. And it's funny, like if you work, for example, at the FAA, you're not really allowed to own airline stocks and things like that. You're actually because you could have information that you probably shouldn't be profiting from. Whereas if you're in Congress, you can own anything you want, even though you actually have far more information. So yeah, from politicians to large pools of capital, there are entities that have bigger edges than others. I think for a smaller investor, one of the edges that a small individual investor has is time frame. So in a professional investing environment, usually they have to do well every quarter. If they have a couple bad quarters in a row, their career could be at risk. Whereas if you make your money elsewhere and you're investing for yourself, the only people that really is looking at it is you and your spouse, and so you're not answerable. You don't have to like sell something at the wrong time. You don't have to pick things that are going to do well in the next 2 quarters. You can pick things that say, I'm going to filter out all the short-term stuff and just focus on the question in 3 to 5 years, will this company likely be more valuable than it is now? You can kind of narrow your focus, and that's one of the few advantages I think an individual smaller investor has compared to larger pools of capital.
Makes sense. One last story, and then we'll let you go. And just because I wanted to get your thoughts, and I didn't even cover some of the other things you had in your investment newsletter, but your advice is so helpful to all of us. Crypto, and Bitcoin. So, Lynn, I was the true story again. It was last summer. I'm walking on the beach of Margate, New Jersey, with like my brother-in-law, and we were looking at the price of, and I don't know nothing about crypto. I mean, I'm not. I don't invest in it. It's, but I get questions about this all the time. And I remember what the price of Bitcoin at the time. And I was making the argument to him saying, like, even if it lost half of its value, it's still, would still be worth, a significant amount. And when you look at its history, it's been at twice the value that it was when we were walking down the beach last summer, And of course, I didn't buy anything, and neither did my brother-in-law. And now we just saw each other last night. We're like, we're idiots, I guess, because now, Bitcoin is more than doubled what it was last summer. It's a volatile area. People like to invest in it, and they think they can make quick money off it. You cover crypto. Please share your thoughts and recommendations when it comes to crypto for the typical Main Street investor, like most of us that are watching or listening to this podcast. Is it something that you would have in your portfolio, even as a small amount that you're willing to lose? And do you really think that it will? Stocks like Bitcoin, or not stocks, but valuable currencies like Bitcoin will significantly increase or decrease as time goes on? What are your thoughts on crypto?
Yeah, so you have to be because they're volatile. You have to size them accordingly for your risk tolerance. That's kind of the first things I'd recommend. In general, I view Bitcoin as highly investable, and not really most of the other cryptocurrencies. Generally speaking, any time in history when there's been a gatekeeper that's kind of brought down, there tends to be a long tail of low quality things. So, for example, when people could self-publish books more readily. On one hand, that's a good thing, but on the other hand, you get a long tail of really low quality books on the market, right? And then same thing for shows and podcasts. People we've gone around the gatekeepers of media, but that also means that there's a lot of low quality stuff that hits the market. And what this technology does is it goes around kind of financial gatekeepers. And so basically, I think the core innovation of what Bitcoin is profound. But then you get a long tail of really low quality stuff coming to market. And if you look at the track record of most cryptos, in a sample of, like, for example, 20,000 of them, only something like 3 of them ever made a higher high relative to Bitcoin in the next cycle. And so they generally have this one big kind of, you know, glorious moment, and then they have this long period of stagnation relative to Bitcoin. So I think the things that are really kind of solving people's problems and that have staying power are probably Bitcoin and stablecoins. Stablecoins aren't really investable in that sense. They're more kind of a utility asset, especially for people outside of the United States that might want dollar exposure. Or as a unit of account for trading. And so that, for me, really is Bitcoin as the one kind of investable asset in the space. And I do think that having a non-zero position in it is prudent.
Okay, that's great. Lyn, you've been fantastic as usual. Lyn Alden is the founder of Lyn Alden Investment Strategy. Lyn, how do our listeners and viewers get a hold of you?
They can check out lynalden.com, or they can check out my book, Broken Money. Thank you for having me.
Yes, I'm glad you were on, and everybody do check out Lyn's book, Broken Money, Why Our Financial System is Failing Us and How We Can Make It Better. Thanks for coming on, Lyn. You're great. I look forward to speaking with you again. Do you have a topic or a guest that you would like to hear on Thrive? Please let us know. Visit payx.me/Thrive Topics and send us your ideas or matters of interest. Also, if your business is looking to simplify your HR, payroll, benefits, or insurance services, see how Paychex can help. Visit the resource hub at paychex.com/works. That's WORX. Paychex can help manage those complexities while you focus on all the ways you want your business to thrive. I'm your host, Gene Marks, and thanks for joining us. Till next time, take care.
This podcast is property of Paychex Incorporated 2024. All rights reserved.